On April 2, 2025, President Trump once again sent shockwaves through the global economy. He announced sweeping new tariffs on a vast array of imported goods. This move, dubbed Liberation Day by the president, marks a significant escalation in his administration's protectionist trade policies. The president invoked the International Emergency Powers Act of 1977, declaring a national economic emergency to justify his actions. This declaration has been met with skepticism and concern from both domestic and international observers. The new tariffs target a wide range of countries, including key trading partners like China, the European Union, and Japan. The decision to impose these tariffs has been met with immediate and widespread condemnation. Critics argue that they will harm American consumers, businesses, and the overall economy. They also fear retaliatory tariffs from other countries, potentially triggering a global trade war. These tariffs are not the first imposed by the Trump administration. Since taking office, President Trump has consistently pursued a protectionist trade agenda. He has imposed tariffs on steel, aluminum, solar panels, washing machines, and a variety of Chinese goods. These actions have already had a significant impact on the global economy, disrupting supply chains and increasing prices for consumers. The announcement of these new tariffs marks a significant escalation in the Trump administration's trade war. The scope and scale of these tariffs are unprecedented in modern times. They threaten to unravel decades of progress towards free and open trade. The potential consequences of these tariffs are far-reaching and potentially devastating. The newly announced tariffs present a complicated tapestry of rates and implementation dates. This complexity adds further uncertainty to an already volatile situation. The baseline tariff, a flat 10% levy on imports from all countries, is set to take effect on April 5, 2025. This baseline rate alone represents a significant increase in the cost of imported goods for American consumers and businesses. However, the baseline tariff is just the tip of the iceberg. Superimposed on this are higher country-specific tariffs scheduled to go into effect on April 9, 2025. These targeted tariffs are significantly higher than the baseline rate. China faces the brunt of these targeted tariffs, with a staggering 34% tariff on its exports to the United States. The European Union is subject to a 20% tariff, while Japan faces a 24% levy. The Trump administration has also indicated its intention to impose additional tariffs on specific goods. These include a 25% tariff on imported automobiles, a move likely to significantly impact the auto industry and consumer prices. Pharmaceuticals, lumber, copper, and computer chips are also in the crosshairs, facing potential future tariffs. The complexity of this tariff structure, with its varying rates and implementation dates, is likely to create confusion and uncertainty in the market. This uncertainty could further exacerbate the negative economic impact of the tariffs. Businesses operate best in environments with predictable regulations and policies. The constantly shifting landscape of trade policy under the Trump administration makes it difficult for businesses to plan for the future. This uncertainty could lead to reduced investment, slower economic growth, and job losses. The Trump administration has offered a familiar rationale for the imposition of these tariffs: the protection of American jobs and industries. President Trump has repeatedly claimed that other countries are engaging in unfair trade practices that harm American workers and businesses. He argues that these tariffs are necessary to level the playing field and bring back American jobs. The administration claims that these tariffs will incentivize companies to relocate their manufacturing operations back to the United States. The hope is that this will lead to a resurgence in American manufacturing and create new jobs. However, economists are skeptical of these claims. They argue that tariffs are more likely to lead to higher prices for consumers, job losses in industries that rely on imported goods, and retaliatory tariffs from other countries. Another justification offered by the administration is the need to reduce the trade deficit. The United States has run a trade deficit for decades, importing more goods and services than it exports. The Trump administration argues that this trade deficit is evidence of unfair trade practices by other countries. They believe that these tariffs will force other countries to make concessions and reduce the trade deficit. However, economists argue that the trade deficit is a complex issue with multiple causes. Simply imposing tariffs is unlikely to solve the problem and could actually make it worse. The tariffs could lead to higher prices for consumers, reducing demand for both imported and domestically produced goods. This reduction in demand could lead to slower economic growth and job losses, further exacerbating the trade deficit. The announcement of the new tariffs sent shockwaves through global markets, triggering a wave of selling and a flight to safety assets. The Dow Jones Industrial Average plummeted 1,500 points, leading a worldwide stock market sell-off. Asian and European markets followed suit, with major indices experiencing significant declines. Investors fearing a global trade war and its potential economic fallout dumped stocks and sought refuge in safe haven assets like gold, which hit a new record high. The sudden and sharp market reaction underscores the deep anxiety about the potential consequences of these tariffs. The interconnected nature of the global economy means that actions taken in one part of the world can have ripple effects across the globe. The tariffs imposed by the United States are seen as a threat to the established rules of global trade and could lead to retaliatory measures from other countries. The uncertainty surrounding the tariffs and the possibility of a full-blown trade war are causing significant volatility in the markets. This volatility makes it difficult for businesses to plan for the future and could lead to a decline in investment and economic activity. The tariffs themselves are also likely to disrupt global supply chains as businesses adjust to the new reality of higher costs for imported goods. The market reaction to the tariffs is a clear indication of the potential economic damage they could cause. The tariffs are a lose-lose situation, harming both the United States and its trading partners. They represent a step backwards from the progress made in recent decades towards a more open and interconnected global economy. The potential for these tariffs to trigger a global recession is a very real and concerning possibility. Section 5. International backlash, condemnation and countermeasures. The international community has reacted to the new tariffs with a mixture of condemnation and pledges of retaliatory action. China, the primary target of the tariffs, denounced the move as economic bullying and promised resolute countermeasures. The European Union, already embroiled in a trade dispute with the United States over steel and aluminum tariffs, vowed to impose countermeasures on $28 billion worth of American goods. Canada, Mexico and Japan have also criticized the tariffs and are considering retaliatory measures. Leaders from around the world have expressed their disappointment and concern over the Trump administration's decision. The consensus is clear. These tariffs are a threat to the global trading system and will harm economies worldwide. The prospect of a tit-for-tat trade war is becoming increasingly likely. As each country raises tariffs in retaliation, the costs to businesses and consumers continue to rise. This escalation could lead to a significant slowdown in global trade, with negative consequences for economic growth and employment worldwide. The international community is urging the Trump administration to reconsider its approach to trade. They argue that dialogue and cooperation, not tariffs and protectionism, are the best ways to address trade imbalances and other economic concerns. The world is watching nervously as the situation unfolds, hoping that cooler heads will prevail and prevent a catastrophic trade war. As the news of the new tariffs spread, the nation found itself divided. Some hailed the move as a necessary step to protect domestic industries, while others feared the repercussions on international trade. The debate was intense, reflecting the varied interests and concerns of a diverse populace. Businesses and consumers alike began to brace for the impact of the tariffs. Companies reliant on imported goods scrambled to find alternatives, while consumers worried about rising prices. The uncertainty was palpable, with many wondering how these changes would affect their daily lives and the broader economy. The spectre of the Smoot-Hawley Tariff Act of 1930 loomed large in the minds of many. Recalling the economic downturn that followed, critics argued that history was at risk of repeating itself. The comparison served as a stark reminder of the potential pitfalls of protectionist policies. Amidst the sweeping changes, certain industries managed to secure exceptions to the new tariffs. These carve-outs were the result of intense lobbying and negotiations, highlighting the complex interplay of politics and economics. For those industries, the relief was significant, but for others, the struggle continued.